There you go. Perfect.
Need to get. I am up, but I'm not running. Why am I not running? There we go. So this is the beginning. We are starting. Will I run out of money today? It's the core question. Will I run out of money before I die? There are so many people that are more concerned with running out of money than they are with dying. It's across all age groups, not just the very old, but many of the very young as well. So I posed that I answered a question because the question was posed on Instapedia several years ago, I think in 2017. This was the question that was posed. I'll let you read it as well as I read it. I'm a 54-year-old married man with 2 children in college. I have enough saved in a 529 plan, along with their scholarships, to provide a full undergraduate education for them debt-free. Grad school's on them. My wife and I both work with an income north of 200,000 collectively. We've amassed about 950,000 in our 401k plans, another 100,000 in savings, and our own $350,000 home mortgage is debt-free. We maxed out our 401k plans at 48,000 a year and also contribute to our Roth at 200 a month each. I estimate that at 65, and of course he's 54, 11 years, with minimal returns, we'll have about 1.3 million and are home debt free. Is that enough? What else should we be doing? So think about it. This is the situation they have. They have 1.3 million at age 65 with continued savings. Their current income is north of 200,000. 3 advisors responded before I did. What do you think? What do you think they said? What do you think you would have said? Do they have enough money at 1.3 million? With Social Security? You know, the hope for each one of the advisors, and yes, I responded as well. Each one of the advisors was hoping to pick up this person and this couple as clients. Everyone wanted to take on these people as clients. So what do you think the first 3 advisors said they would do? What do you think they said? What would you have said? Do they have enough? Maybe somebody's here with just a similar kind of situation. It's not abnormal for people to be at that point. 1.3 million looks like a lot of money. And maybe you're at that same situation. You know, the first 3 advisors all congratulated them on having 1.3 million. They didn't actually expound on what they would recommend. One did mention that at a 3% withdrawal rate, that would mean they could take 39,000 a year in income along with Social Security that they'd get. They did talk about listening to the couple and talk about their goals and talk about what they would do in retirement. They wanted to discuss objectives. They wanted to discuss and know about the couple themselves beyond just the nest egg. But they really never did propose what they would do with their situation. Think about it, 1.3 million at 3% is 39,000 plus Social Security. That's a shortfall, don't you think? That's what I thought. This is how I responded. I said that 1.3 million seems like a big chunk of money. However, with only 1.3 million, you run a significant risk of running out of money before you die. One of the financial advisors had pointed out that a 3% withdrawal rate would earn 39,000. And if you both get maximum Social Security, you'll have a total income of about 100,000 per year. So you're replacing about 50% of your current income. you risk running out of money in your mid-80s. And the average life expectancy of someone who's 65 years old when you retire will be in the high 80s. And that's if the current trend continues. Half of the 65-year-olds, actually even more than that, will live longer. The fastest growing segment of the population is centenarians. That's where they stood. That was the first part of my answer. But I went on to continue to say, the reality is you really need almost 4 million to maintain your current income without a risk of running out of money based on the 3% withdrawal rate. Why 3%? Back in the 1960s, a 4% rate was what was determined to be a good withdrawal rate. But returns aren't what they were in the 1960s. People are not achieving the same kind of returns that they had with defined benefit programs, with those pension plans that companies offered at a 4% rate. People were retiring with more money than they have today. 4% was a decent return back in those days. Today, there's a number of companies that have shown that the most people should withdraw, given most financial advisors and what they do, is 3%. So 4 options for them to consider. You can save more. It's unlikely you'll get to where you need to be by saving unless you save a lot more in the next 11 years. The second option is you can work longer and postpone retirement. And we're seeing that happen more and more and more today. People having to work beyond 65, or people who retire from their existing job, getting another job before they turn 65. The third thing you can do is you can seek better returns, or you can do a combination of all above. My response was, I wish I could say you have all you need, but in honesty, that would be deceiving you. You're short. If you continue to save as you are now, work an additional 2 years to 67 and achieve an 8% return, you should be close to the 4 million you need. 8% return. That is very significant from what most financial can do. I went on to say, if you plan to use a financial advisor, I recommend doing so, finding one who publishes at least a 10-year track record showing a composite for all accounts with no carve-outs. Some composites carve out new accounts, poor performing accounts, and terminated accounts. So you want to be sure that all of those are included. And be sure that the track record is actual and not a back-tested hypothetical return. The reality is you're asking the right questions at the right time. You have enough time to achieve a successful retirement and enjoy your golden years. That was my response. It wasn't a very nice response. And for sure, they didn't open an account with me. I don't know which of the advisors they opened one with, but not one proposed doing much different than they were doing. And I would guess that none of the advisors had really approached it that way. They congratulated them on having achieved 1.3 million. And that's a lot more than most people have. Probably more than 40% of Americans have. But you can see that that's falls short, significantly short of what's needed. The fact is we're living longer at an increasing cost. And the risk for running out of money in mid-80s, in people in their mid-80s, is real. Google this on the website. Just Google the templates for eviction letters for evicting elders out of assisted living. You'll find a whole long list of templates for evicting people out of assisted living, for evicting people in their 80s and 90s. What do you do when you evict somebody from assisted living or from memory care? I mean, that's going on today in today's society, in the richest nation in the world. That's what's happening. We're seeing people evicted in their 80s and 90s. And what's the chance that someone in their 80s or 90s is that's coming out of a assisted living home is going to be able to work? You know, I'm 82 years old. I'm work full time. I am in good health. Things are going really well. I feel that I'm going to be able to work for a long time. But a lot of people are not in my situation where they're in their 60s or 70s and need a retirement income. Running out of money is reality today. It's reality in a growing number of people and a growing problem for families as they face this. You know, looking at the data, here's the replacement. Back in the 1960s and 70s, data was determined that you only needed to replace 80% of your paycheck. Only 80%. And with a 4% return and withdrawal rate, you could replace your paycheck if you just had 10 times your earnings as a nest egg. So I did that. I didn't do 4%, but I did 3% to look at what somebody would do. $15 an hour, which is higher than a lot of minimum wages in this country. States are beginning to raise the minimum wage, but some of the minimum wage rates are at $7. Someone earning at the end of their working lifetime $15 an hour, if they've saved 10 times their earnings, they'll have $300,000. 3% of that nest egg is going to give them $750 a month. Their Social Security is going to be $630. Their total retirement, $1,380. They replace only 55% of their income, even earning $515 an hour. People who earn $100,000 with $1 million in savings are only going to replace 67% with Social Security. 150,000 reach the maximum Social Security of $5,251 a month. 3% from 10 times their current income will give them $3,750. They replace 72%. But our couple with 200,000, if they have 1.3 million, 3% earnings, $3,220, $3,250 plus Social Security is going to leave them short of what they need. Does that make sense? Are you following me along? I mean, these are numbers and a lot of numbers, but they're real. They're very real. And if you look at the average 401k, the average balance in a 401k is short of 500,000. So people are not saving enough. People are not going to have enough. They're either going to have to continue to work for a long time beyond retirement, or they're going to drastically reduce how they live. That's the data. That's where things are. So I looked at it in another way. I looked at it in terms of the nest egg at 15 times earnings with a 3% withdrawal rate and what the income would be. Looking at our couple, 200,000 at 3 million, not 1.3, but 3 million. Even at that rate, they would only replace 77% of their income. Here's at 150,000 a year, they replaced 87. But because you're maxing out Social Security, the amount coming from Social Security versus the nest egg continues to make a draw downward. That's where things are. That's where we are today. Having 15 times your earnings. That, for the average financial advisor, a 3% of earnings from the nest egg is going to leave people short. So what do you really need? That's the question. What do you really need? Looking at these different numbers, $15 an hour, what they really need to replace 100% of income is $543,000. We recommend people replace 130% of their net income. We believe that for 100% of replacement of income, what we're seeing are increasing healthcare costs. Healthcare's costs are increasing much more rapidly than the consumer price index, much more. And if you look at what's going on in the grocery store, if you look around and see what's going on in clothing and any number of different stores, you're seeing a significant inflation impact. The consumer price index, a big portion of it is based on housing. So for many couples or many single retirees, the housing cost has probably been pretty well taken care of. Either you're renting a house or a condo, or you own a house and probably debt-free. But what we see is in order to compensate for increasing healthcare costs, to compensate for increased transportation cost, and the different cost of living, we don't believe that 100%, a replacement of 100% of today's income will do it. That's not an appealing situation, and yet it's real. There was a time when replacing 80% was adequate, but how does it work anymore? Not anymore. You know, in 1986, when I got started in this business, I had a widow who came to me. She was age 57. Her husband had died 8 years prior in 1978, just as inflation was at its peak, and inflation took a number of years to come down. Her husband died. She had the insurance money. With the insurance money, she had a complete, actual 100% replacement of her income, of what the couple's income had been. The house was essentially paid for. In 1978, her situation looked really, really good. But in 1978, the investments were made in bonds with a few stocks, but very, very little stock. The bonds were furnishing a very nice income. But what happened by 1986, when she became a client of mine, the bonds had been called away and the new interest rates were significantly lower. From rates of double digits in 1978, the rates now were down to the 5 and 6 and 7%. That was a significant drop. But not only that, prices had increased from 1978 to 1986 by a significant amount, by almost 50%, somewhere between 40 and 50%. I don't remember the exact numbers off the top of my head. But that widow had seen her income drop by 30%, and she'd seen prices go up by 30 or 40 or 50%. So when she came to me in 1986, in 1978, she had had plenty of income to meet all of her needs. By 1986, she was the shortfall of almost 40%. She was drawing down principal in order to meet her necessary, and she was down and trying to live on less than 80% of her former income. That was where she lived. That's where she did, and that seemed like a situation which fits much of today's situation. That widow became a client. We revamped. She began to take not a 4%, but 8% out of the portfolio. The portfolio continued to grow over a period of time, and the widow ended up at age 90 in 2010. Actually, she passed away a month before her 90th birthday. She had been able to do 100% of her income and increase it over that period of time to account for the extra inflation that was going on. And inflation did continue from 86 until the early 90s, significant inflation. After the early 90s, inflation eased off, and that was also an ease for her. But we feel in order to meet your needs, you need 130% of your income. For our couple, the couple that I started with, 200,000. If you just get 80% of replacement, that's 2 million. 100%, 2.5 million. 130% puts them between 3.3 and 5.8 at a much higher withdrawal rate. Not at 3% or 4%, but even higher than that. That's what people need, not to run out of money. That's where we are today. Think about it. Is that enough? When my father was my age, my father had been dead actually for 21 years. My father was nearing retirement. He worked for Pacific Gas and Electric. He was approaching retirement at age 61, planned to retire at age 62. And there was an annuity that he could have opted for that was a 5-year annuity, because most people at age 62 or 65 didn't live beyond 5 years. And if their health was any questionable part, you could draw down and take a 5-year annuity, or you could take a pension that lasted as long as you lived. And you had a survival benefit as well. My father passed away before I reached age 62, but I'll never forget when we talked about his retirement, and he talked about this annuity, this 5-year annuity. And yes, my father did live beyond, or didn't live to age 62. He was one of the early deceased people. But that has changed since then. That was 1978 when he passed away. Today, passed away, similar situation to the widow whose husband passed away in 1978. That's where things are. That's where things were then. Things today are very, very different. We're living longer and longer. The fastest growing part of our population are the people over the age of 100. People are retiring at age 65 or age 67, and many are retiring from a job they never liked, but they just had to get through retirement. And then they're going on to do a second career at something they like. Many people are retiring today at 65 or 67 and needing to take an extra job. If you look at McDonald's is pretty famous for hiring retired workers, people who need to be retired. Go to a Mariners game. Go to a Mariners game and look at the number of retired ushers, retired people that are going up and down the aisles with beer and popcorn and peanuts. Those are people that need the extra income. They did not retire with a need of 5.8 million. They didn't retire with 4 million. They were like the couple who retired with 1.3 million. You have to go on and work longer when that happens. And for sure, you don't want to end up in assisted living when you're my age and be kicked out of an assisted living home. You don't want to be 90 years and kicked out of a retirement home. You don't want to be kicked out of an assisted living place. You have to look at your nest egg. You have to be realistic about it, and you have to plan for it. If you are retired now, and I don't know the makeup of the people that are in this workshop, but if you're retired now, you should be looking at what you can do to increase your nest egg. If you don't have 130% of the salary or the income you had when you retired, you need to look at how you can improve that, how you can improve your returns. If you're in your 50s, it's a good time to prepare and think about what you can do. And I believe it comes down to the performance of your portfolio. And maybe I say that because of how well we do. Because these are our results. This is how we've done. This is as of the end of 2025, as of the quarter that just ended. For a person that started with us in 2009 and started with an income, with a nest egg of 500,000, that's grown to 7.4 million. 500,000 to 7.4 million over a period of 16 years. Not a bad return, huh? Not bad. Those people are in much better shape than our couple that were 53 and had 1.3 million. This is where we are. I put this slide up because while this has been the trajectory of our clients, this is the average financial advisor client. And that's based not on just some wild numbers picked out of the air, but it's based a couple of years earlier on estimated values. But Cerulli did a study which found that advisors were achieving small returns of a couple percent during 2011 and 12. I estimated this period of time. But since then, there have been studies, annual studies, that show what financial advisors are doing. Investment News and Moss Adams have done studies showing these are the returns achieved by financial advisors. Minus 2.4, 5.1, 8.4, minus 4, 10.9, 24.9 during 2020, 12, minus 11, 10.5. And the 10.5 was something that was done by an ensemble practice, Schwab and BlackRock, showing that the average Schwab advisor during 23 achieves 10.4, but the average financial advisor by Investment News and Moss Adams. And there was one other firm. Anyway, 10.5. This is where things are. This is where Adams Financial Concepts has been. This is where we are on this result. That's comparing us to the average financial advisor. And if you look at this, the average is a little over 5% for the average financial advisor. So a 4% withdrawal rate is really detrimental to them. That's where we are. But we don't just compare ourselves to the average financial advisor. Our goal is to actually beat the S&P 500. And if you look at where we are, that 500,000 grew to 7.4 million. We've averaged 17.5% for our clients versus Standard & Poor's 15.82, 86. That's where the average, that's where the Standard & Poor's is. It's the most difficult average to beat. I've seen advisors compare themselves to the international index. That's less than that. So this is where we are. We've been above it, we've been below it, but if you look at over this period of time, that's where our clients are. And yeah, if we had a client starting here, and we've had clients starting in this area, they're beginning to reach new highs now, but they've seen significant drops before we got there. That's part of where we are. We have more volatility than financial advisors, but we're on our way there. And I can't talk about that without talking about our disclaimers, because past performance is no guarantee of future performance. On the other hand, the best indicator of past performance or future performance is past performance. We do use the Standard & Poor's 500 with dividends reinvested as compared. That was the The slide that I showed, that is the S&P 500 with dividends reinvested. Our managed accounts include all active accounts. We don't have any carve-outs. It includes every account to beat the S&P 500, and every contract we sign, whether it's a conservative account or an aggressive account, includes the phrase that we seek to beat the S&P 500. It includes all of our equity accounts. Some accounts that began with us prior to the time that I formed Adams Financial Concepts. The oldest account is now 40 years old as of December 31st. It started December 31st, 1990. The actually was before that, before it became a fee-based account. But that includes all those accounts. It includes accounts with at least 1/4 of data has been with us for at least one full quarter through the fourth quarter. It includes accounts that have been terminated either due to death or people transferring out, and we do lose a few people. It includes all those accounts. And they're net of all fees, expenses, and costs. The results that you see on this slide, the results are the real results. Net of all fees. Those are the net values of clients. So it's not a gross, it's a net. And they don't include the results of the incentive profit accounts. Incentive profit accounts require a minimum of 1 million or 1.1 million of investable assets, 2.2 million, 2.1 million in total net worth, excluding home. So it's the actual performance. The portfolios are concentrated in as few as 8 equities, and we'll talk about that next week. And we believe in putting all our eggs in one basket and then watching the basket. It includes capital gains and losses, realized and unrealized, but doesn't include the impact of taxes. Somebody has to pay the taxes. That's external to this. I love the quote from Peter Lynch, "I'm fully invested. It's a great feeling to be caught with your pants up." And we know that there's going to be times when there's going to be periodic losses, setbacks, unexpected occurrences, and calamitous drops. They don't scare us out of the market. Fewer than 7% of professional money managers do as well as the index, and fewer still beat the index. I think the studies show that we are in the top 1% of all professional money managers, and I don't know of any financial advisor that achieves that. That's where we are. I think there's a need, if you're not at 130% in your portfolio, if you haven't replaced that, can't replace your income by 130%, you have a significant potential of shortfall in your lifetime. How do you get around that? Work longer, save more, or get better performance. That's where I am. That's my helpful analysis of what's going on. And with that, I'm ready to look for questions and discussion.
Mike, that was super informative, and thank you for that. Hey, everybody, it's Chris Prouty, and I'm back, and I'm here to relay questions to Mike. So there are 2 different ways that you can ask those questions. We have the webinar chat, and if you are going to ask a question in the chat and you want it to stay private, just make sure you send that to hosts and panelists, or you could also ask questions in the Q&A. You can find buttons for each of those at the bottom of the Zoom window. So, Mike, somebody asks if you have a specific retirement savings benchmark by age, like, for example, 1 times the salary by age 30, 3 times the salary by age 40, and so on.
I don't. Because if you look at our returns, our young people, now, are saving way beyond what they need for retirement.
Mm-hmm.
They're way beyond 130%. Some are several 100%. So that's, you know, I don't have a specific thing.
Mm-hmm. Mm-hmm.
I just want people to have, our clients to have 130% and more going forward. That's what I want.
And Mike, somebody's saying 130% of what figure?
Of your last earnings,
Okay.
your last salary. So if your last salary was 200,000, you should have enough to generate with Social Security 130% of that
Of,
salary.
of
You
that.
should
So
be able
two.
to generate 260,000 in income per year.
Okay. Got it. Got it. Thank you for that clarity. And Mike, somebody says, can you comment on silver moves? I don't know what that phrase means, but maybe it means something to you.
On the what silver's gone up?
Is that if you I could just get some clarity on that question. Do you mean on silver itself? Sometimes we think of the word silver as retiring, meaning people who are retiring, the silver group. If I could just get some clarity on that. Comment on silver moves. Just give them a second to do that. And while I'm waiting for that clarification, friends, in the webinar chat, I've included two links. One of them is Mike's email address. You can send Mike emails, and I know he checks and responds to every email he gets. So if you have specific questions that you want to address with him through email, his email address is right there. And then the other link that I gave you is a direct link to the YouTube channel where you can see the replay of this episode as well as all previous episodes and some other great information. And once you head over to that YouTube channel, if you just click on that subscribe button, that helps us a lot by letting YouTube know that we're providing valuable information. So, Mike, I haven't gotten any clarification on that. So,
Oh,
perhaps commenting on the precious metal markets.
so precious metal, you have three things which determine the price of precious metals. Um, Number one, like the stock market, like paintings, like everything, markets are perception markets. Art Bernard, Bernard Baruch stated it. Art Cashin, the late Art Cashin, uh, rephrased it. Art Cashin put it into terms that you can better understand. He said that when the market believes that 2 + 2 = 5, they'll pay 4 3/4 for it all day long. My corollary is that when the market believes that 2 + 2 = 3, what they bought it for in 3/4, they'll sell it 3 1/4 all day long. So it's a perception market. The value of gold or silver or platinum depends on several things. One is the actual usage of the precious metal. Um, use of gold in jewelry and fillings for teeth, all those things that go into making up the demand for gold. That's one aspect of it. Inflation is a second aspect and probably the greater aspect. As inflation increases, people are willing to pay more. In theory, the suit I bought 20 years ago, and if I would have paid for it in gold, should be the amount of inflation plus to pay it again in gold. The same amount, the price increase of a suit or whatever, the average price increase should be related to inflation. But there are times in which geopolitical events will happen. When there was an invasion of the Ukraine, gold prices shot up, prices go down. Prices really shot up in 1972 when the dollar was decoupled from the price of gold. From the 1930s until 1972, the price of gold was fixed, or the price of the dollar was fixed to gold, 32 ounces of gold to $1,000, was it? I can't remember exactly the numbers. But in 1972, as inflation was really leaping up, and people were drawing gold out of Fort Knox. Central banks were trading their dollars for gold from Fort Knox. Nixon decoupled gold from the dollar, and gold, I think, shot from $32 an ounce to, yeah, $32 an ounce, from $32
Mm.
an ounce to $800 an ounce. And then the price collapsed back. Today, the price has been going up, probably because of concerns over several things. One is inflation, because we're seeing worldwide inflation. And secondly, we're seeing a reversal or a change of the world order. So you're seeing precious metals go up, gold and silver, other metals and precious metals going up because of the concern over the changing world order and the stability of what's happening with the dollar, with the euro,
Hmm.
with different
Hmm.
currencies. So yeah,
Yeah.
whatever, whatever, it's a speculative thing. It's,
Mike, somebody's made the comment that silver has gone parabolic.
oh yeah, I remember, I wish I would have bought gold in 1972. It went parabolic too. Um, just because it went parabolic, well, you also had the Hunt brothers try to corner the silver market. Uh, it was a funny thing. There's a lesson to look back at the Hunt brothers. The Hunt brothers in the 1970s, 1980s, I can't remember the exact dates. They decided they were going to buy up all the silver in the world.
Mm.
And then with all the silver in the world, they could set the price of silver. And what happened is as they were buying out silver, there was a lot of silver that had been put away as a hedge in India and China, but more in India than China, I believe. But all this silver suddenly became pouring out of people who had hidden it away as a
Mm.
reserve.
Hmm.
Um, and suddenly the Hunts had figured what was the total value of silver in the world. And I think the amount really almost doubled. But I'm
Mm.
speaking out. I don't have the numbers here. I just remember the situation.
Mm. Mm.
So,
All right, Mike, get ready. This question coming in is a big one. I've been retired 6 years. My wife and I currently take out $3,000 per month, which is enough to supplement our $6,400 a month Social Security. We are 72 years old. We currently have 2.8 million in our retirement nest egg. We have earned an average of 6.9% since January 2021 in our portfolio. I didn't gather enough from your talk to do my own math problem. How would I calculate whether we have an adequate nest egg? Thank you. That's a big question, Mike.
so as I see right now, you have 9,400 coming in. Um, and 2.8 million is, so 9,400 a month times 12 is 108, about 120K. So you're taking a little less than, you're taking about 4%. And the issue, even though since 21, or since 2021, we've been living in a very good time. Yeah, we went through the inflation period of time. But you have a couple things. If you can achieve a 6.9% return, let me back up a second. I need, if you look at what a safe amount to take out of a portfolio is, I use an extreme example. An extreme example is uh, if you want, if you have 100,000 and you need 20,000 a year, So the first year the market goes up, your portfolio goes up 20%. So you have 120,000, you take out 20,000, you still have 20,000 left. Second year the market goes up, or your portfolio goes up 20,000. And so you have 120,000 at the end of the year, you take out 20,000, you still have 100,000 left. Third year, you have 100,000 when you begin, but this time the market goes down 20%. And so you have 80,000 at the end of the year. When you take out 60,000, when you take out 20,000, now you have 60,000 left, not 100. And in order to get to 120,000, you need the market to be up 100%. So having a 6.9% return, if you can continue to do a 6.9% return, you're probably right at the border, taking out 4% on your portfolio. So you're very, very close, assuming that we don't have a significant impact from inflation or stagflation. As long as things continue along on the path we're going right now, you're probably going to be fine. On the other hand, you don't have any real margin of safety. If we see a real downturn, if we see stagflation like we saw in the 60s and 70s, you don't have a margin of safety. You don't have enough to get through that period of time.
And so, Mike, a comment of clarity. They're only withdrawing 36,000 per year, which is 1.3% of the 2.8 million.
Oh, okay.
They're currently taking 3,000 per month from their investments. They're also getting 6,400 a month in Social Security. So they're at a 1.3 withdrawal.
Okay, you're fine. Absolutely fine.
Mm-hmm. Mm-hmm. That's a great question.
Yeah.
I like doing a little bit of math.
You've done well.
Yeah. Yeah.
That's assuming that your 2.8 million continues to grow at 6.9%. You're doing great.
That's inspiring, isn't it?
So,
Mike, I have a question for you.
sure.
So always a pressing question on my mind right around this time every week. What topic is coming up next week?
Next week, how our composite of clans has beaten the market. So if I go back to this, how did we do that? And the answer is only partial next week. It lays out the the 3 principles on how we do this. And you know that you can't come up with a complete answer in 1 hour or 40 minutes.
Mm-hmm.
But we're going to start and talk about why we achieve those kind of returns.
Amazing.
And I will say one thing about it before we get there. You don't get to that kind of return if you play Wall Street's game. You can't get that kind of return, in my opinion, by playing Wall Street's game.
Mm-hmm.
You have to go beyond that. But that's a question that I'm going to talk about what we do to beat the market.
I'm looking forward to that one, Mike.
3 principles.
That is coming up next Thursday, and that's coming up at 11 a.m. Pacific time. That is 2 p.m. Eastern time and everywhere in between. Mike, that wraps up all the questions that we have. This was a great conversation today. Thank you, everybody, for being here. I'm looking forward to seeing you, Mike, next week and seeing everybody else here next week. And Mike, with that, bring us home with the final word.
So have a very good week. We have some people that have been listening that have enough for retirement. If you're not in that situation, please think about what you need to do to get to that situation. And with that, have a very wonderful day. And I will be back next Thursday. And if you miss any of these, you can find them on YouTube. With that, take care, and I hope to see you next week.